when we say financial restructuring, what do you have in mind? Can you comment? What do you have in mind as far as what financial restructuring is all about? Anybody here? It's fine. It's fine. We are going to learn anyway, right? Now, when we say financial restructuring or corporate restructuring in general, okay, we are referring to how the organization is reorganized in a way that are introducing certain financial techniques. I'll give you an example, for instance. When a company is thinking of a certain strategic direction, we need more customers, for instance. Then this company is tying up or merging with another company that can sell its product. If the company has problems in the raw materials procurement, then it said, okay, strategically, the company is going to tie up backwardly with a company that will provide the raw materials. Now, I understand that you have the materials, in front of you as far as what we are going to go over now. I do not have any PowerPoint. I would like you to take a look from the Word file that I have sent earlier. Now, this is what we have as far as corporate restructuring is concerned. We have, sometimes, we should not be mixing. We should not be misunderstanding what they are. Basically, we have the organic internal restructuring. We have the operational restructuring. We have the managerial restructuring. Of course, we have the financial restructuring. Now, this is the thing that we are going to concentrate on, the financial restructuring. So financial restructuring, as I said just now, is basically reorganizing how assets and liabilities are structured. Whether it is a merger and acquisition, whether it is a spin-off, whether it is a leverage buyout, these are financial techniques. Yeah. These are financial techniques. Anybody here, of course, have heard about mergers and acquisition, right? But what about spin-off process? Have you heard about that? Spin-off process? Okay, we are going to learn now, okay? What about leverage buyout? Have you ever heard about that terms? Yes, okay, good, very good. Now, this morning we are going to review, the three, yeah? That is the spin-off process, the merger and acquisition, especially acquisition, and the leverage buyout. Now, there's one thing that, we have to understand. The word financial modeling. Without realizing, when you work with Excel, and when you work with, let's say, budgeting, when you work with pricing, when you work with costing, basically you have engaged in a financial restructuring process. That should be made understood. Yeah? So now we are going to, again, continue the process of financial modeling, but in financial restructuring, right? So you understand. Now let me ask you, what have you worked in? What have you been working on the Excel? Can you comment? Can I hear some of you? When you work with Excel, what are you working? Budgeting is one, right? What else? Coin?
Statistic record.
The?
Statistics record.
Yes, okay. That can also be, but part of anybody here. When you work with Excel, what have you been working with?
Financial statements.
Financial statement analysis, yes, that's true. What else? Anybody? I believe that you understand my questions, and you have been doing this a lot, yeah? Financial statement analysis, budgeting, what else? Pricing exercises, pricing, of course, pricing a product, pricing a stock, pricing whatever pricing you have there. Transfer pricing. I assume that everybody here, is from the accounting and finance field, right? So I think you are familiar with that. Okay, good, very good. Now, in financial restructuring, we are going to take a look at all those. Now, let me go over with you what are the types of financial restructuring in practice. Okay. Now, a simple example of a financial restructuring is what? Selling fixed asset. So most probably, what are the fixed assets that are being sold? Anybody here can say? Equipments, what? The most important thing is building, yeah? I still remember when I was still in the banking sector, that time, Bank of America was in a declining mode, yeah? And I had friends in New York that time who were working with the Bank of America. Then they're telling me, oh, I think we are now restructuring financially. Why? How? Oh, we are selling our property here and there. You see, all over the world. This is part of what? This is part of a strategy on how financial restructuring is being performed. Yeah? Simple selling of what? Of the asset. Yeah, of course, it is not the main asset, of course, because the banks are still using the main asset for operation. Yeah? But this is just an example. Yeah? A sale of asset and selling asset to streamline operation and earning cash flows at the same time. You see? Yeah? This is a simple, example. The second one is, of course, everybody has heard about mergers and acquisition. Yeah? When we say merger and acquisition, anybody here can tell me what merger is and what acquisition is? You can say?
Merger is A plus B become AB.
Very good.
It still exists, but for acquisition is you take control of the company.
Exactly. Very good. Very good. Yeah? A merger is basically a tie-up or a combination of more than one companies, with one company is only surviving. Yeah? The legal entity of these 2 or 3 companies, merge, and they come up with only one company. But acquisition is like buying a company. That's all. So, accounting-wise, if A is buying B, accounting-wise, B is reflected in the balance sheet of A. Yeah? So they are still separate companies in terms of its legal entity. Is that clear, right? So that is, thank you so much. What's your name? Fizi.
Yeah.
Thank you so much, Fizi. Yeah, that's very good. So mergers and acquisition. And this mergers and acquisition, takes a long process, I tell you frankly. Well, it could be also a short process. I had I had experienced this process for quite some time in the past when I was still in the banking sector, especially in the investment side. It will take some time as far as dealing with the due diligence with so many parties, especially the professional parties. Yeah. The investment bank is one that is very important in molding what to merge with, what to acquire. You see, the mergers and acquisition is not a simple process, but it will take some time. Yeah. There's some merged companies that have successfully operated after the merger. There are some that are not successful. You see, you have to really analyze. Of course, everybody would like to see the post-merger is successful. What is the merger for if you think that after the merger it is not going to be successful, right? That's why the process is taking some time. Now, the second one in this one, mergers and acquisitions, combining two or more companies with the same legal entity or just buy the firm. So just buy the firm refers to acquisition, but merging with two or more companies refers to the merger itself. Yeah? Okay? So that is part of the financial restructuring that one is trying to put up together. Now, the third one. The third one is basically a common practice. Everybody has heard about joint ventures, right? Joint ventures. Like, for instance, an American company comes to Thailand and are coming up with this collaboration, with this cooperation with a Thailand company. That is a joint venture. Yeah, a joint venture, has a certain synergy that, of course, like the mergers and acquisition, to accomplish. Yeah, it is basically collaborating in a direct investment venture by equity. So if the American company brings in some equity, the Thailand should always match with another equity. Yeah, depending on what the government is saying as far as the percentage. Some government is saying that, okay, the foreign company should not own more than 49%. The controlling company should be the Thailand companies. Yeah, I think that's it. Or the government can say, okay, fine, it can be, the foreign company can be, owning more than, or majority stake in the joint venture itself. It depends, yeah? It depends. And in a joint venture, of course, this is a common, practice that many countries, are doing to learn the technology, yeah? Like, for instance, a company would like, or let's say a country would like to learn of how to make, let's say, ships, yeah? Ships, for instance. Then the American company, which the Thailand company is going to join with, it is some companies that know how to make ship. And the transfer of technology, takes place together with the equity of the foreign partners coming into Thailand. You see? So that is a joint venture. So joint venture is basically the simpler forms of tie-up combinations. Yeah? Okay. The fourth one is split up. Split up. Now, as you know, if you look at the materials, I have been using Hewlett-Packard, yeah, as an example, because we can learn a lot from Hewlett-Packard. all those financial restructuring strategy, yeah, starting with split off, yeah, starting with spin-off, carved equity, mergers and acquisition, they have experience. Because we know that, mergers and acquisition, remember this, you should know this. Mergers and acquisition is basically a continuing economic strategy. One of my old books was about mergers and acquisition. You can type in the Google, but that's an old book, yeah? 2004 or 5, 2005. You can type my name, Eric Y. Nasution, and you can find one of these books, yeah? Entitled Mergers and Acquisition of Philippine Banks, an Economic Strategy. So what I said just now, mergers and acquisition is an economic strategy. If you would like to survive in a business, you need to do this, financial restructuring, either merger or either acquisition. Yeah? So it is important to know how the restructuring is going to be performed. Okay? The fifth one is, I think we are still on the fourth one, right? And the fourth one is split and transparent strategy. Like, for instance, Hewlett-Packard. Yes, Hewlett-Packard. Hewlett-Packard, before, the name of Hewlett-Packard is just Hewlett-Packard and Company. But, it has split, yeah, into two companies, Hewlett-Packard and Hewlett-Packard Enterprise, yeah? And this split, yeah, this, financial restructuring strategy has, of course, an intention of what? Yeah? They would like to specialize in their own product. Like, for instance, Hewlett-Packard is concentrating in what? In computer, PC, and so on. Well, the other one, will concentrate on the other part of electronic products that they are producing. Yeah? So this is another strategy as far as split up is concerned. The fifth, which we are going to learn a little bit more as the first agenda in our exercises, yeah, in this workshop, is spin-off. Spin-off, why it is spin-off? Can you imagine a company? A company with several divisions. Yeah? There are cutting divisions, there are molding divisions, there are fabrication divisions, there are finishing divisions. Can you now imagine? Can you imagine one of these divisions separate itself from the company and form a company? Yeah? So I think this is very important. So let's assume that the molding division is separating from the company. Let's say, whatever it is, yeah? So the molding company has separated from the company and forms its own company. This is spin-off. Yeah? But it's not just division, but also subsidiary within the group. Yeah. In the American setting, organization will take place in a form that sometimes we could not understand because it is sophisticated as far as how it is organized. You have a simple organization, you have a matrix organization, you have, like for instance, a group of company. Can you imagine General Electrics? Oh, well, I think this is General Electrics when I was still small until I understood what General Electric is. I think it was a long time ago. Yeah, it was a long time ago. General Electric, I understand before, is producing this refrigerator. You see, refrigerator. Yeah, in a matrix organization, General Electric is organized in such a way that it has its electronic products, it has appliances, it has diversified itself also to the other business, like property, other, IT products, and so on. You see? But, nowadays, a company can be a conglomerate. From a simple, product-producing firm into several, firms that are producing several different products. I think we should understand that. Yeah? Now, so subsidiary within a certain company can also be. So what happened here, in the spin-off, turning a division or subsidiary into a group, into a new firm for a near future IPO. Hewlett-Packard, has its optoelectronic subsidiary. And this is being what? It is being taken out from the group, and it forms a new company. And that company is called Agilent Technology. I think this is what we are going to learn. Yeah, we're going to learn using using Hewlett-Packard and Agilent Technology's financial statement. Yeah, we're going to look at that when in the exercise portion of this workshop. Okay. The other forms is. The other forms is, the other forms is equity carve-out or partial spin-off. So in the equity carve-out, selling partial equity of a subsidiary for cash in an IPO. Now, in the spin-off, they are selling all the subsidiary or all the division, yeah, and form a new company. But in a carve-out, it is only part of the equity that is sold. Yeah, that is the difference between that spin-off and carve-out. Yeah. Now, the next form is share repurchase, dealing for a better pricing. Yeah, share repurchase is buying back existing shares from the shareholders or through treasury. In accounting, I think you are familiar with what is called treasury stock. Anybody here has heard about treasury stock? Yeah? And normally, treasury stock is being used. This is part of a restructuring, financial restructuring. Is being used for what? For a purpose of making a better profit. So the same treasury, the same stocks of the company are being bought back. You understand, right? Normally in the equity, we are going to deduct this, yeah, from the stockholders' equity. Yeah, because it is no longer roaming around, In the cell phone, you have known this word roaming, Even when I came in the Philippines, everywhere I go in this part of the world, if I open my handphones, the roaming comes up. Welcome, so, welcome to this country and so on the roaming facilities, as always. Yeah. So what happened here is that the stock that are outstanding in the market is being bought back at, let's say, at $10 per share. And then when the stock itself in the market becomes 30, that's the time when the treasury stock is being sold at a profit of 20 per shares. Yeah, I think this is part. You have been learning this in the accounting sections and financial sections of your. Oh, sorry. What happened is that battery is running low. Oh, okay. Is that? Yeah. Okay, it works. Thank you so much. Thank you for reminding. So it means this doesn't work then. Thank you. Okay, good. Okay, that is share repurchase. The next one is liquidation. Liquidation, of course, everybody knows. You liquidate the, the company itself. I think we don't have to talk more on this. Disposing of remaining assets and returning the cash flows to the shareholders and creditors. And the last one, of course, bankruptcy. We don't have to also further discuss about this. Bankruptcy, of course, is the legal status of a business entity that does not have the capacity to pay creditors. Okay, and that's why it is declared bankrupt. Now, as far as this first section or first explanation of what these financial restructuring is all about, is there any questions? Yes, sir.
Could you explain a little bit about envelope? You gave the strategy and the reason.
Yeah.
Can you explain the reasons a little bit of the strategy? For example, synergy-related transparent grant strategy, the evaluation.
I see. A strategy and the reason. Yeah, okay. Yeah, okay. On the first one, of course, the first one is selling asset, right? Well, basically the reason is to what? Accumulate cash flows, yeah? On the mergers and acquisition, the reason is to take advantage of synergy. And the synergy, a company with two, let's say, resources, another company with two resources are being tied up with an expectation that they're producing 6. Not 2 plus 2 is 4, but, there are synergistic effects, yeah, that one of these companies are expecting. Like, for instance, good reputations, good distribution system, and so on. So I think that it's the synergy that is being expected. The joint venture, of course, is talking about the same synergy. A split up. And the split up, it is on the transparent brand strategy. I'll give you an example, for instance, that Hewlett-Packard. Hewlett-Packard itself, is concentrating to PC, computer, competing with IBM, Microsoft. You understand this, what is happening in this PC business, right? And the other, HP Enterprise, is concentrating on the optoelectronic, you see, on the process, including the, the advisory itself, advisory product. So it is basically on the brand, yeah, that they are looking at. The split is also a transparent brand strategy, yeah. Spin-off, in the spin-off, we are going to learn now on how a division is taken out of a company and it is forming a new company. It is for a better valuation, yeah, a better valuations and more competitiveness, yeah. So I think this is this spin-off is really now equity carve-out is also the same thing as far as a better valuation is concerned, plus certain partial spin-off, just to help support the spin-off process itself. Share repurchase is basically dealing. As I mentioned just now, if let's say a share are being, bought for a treasury at a price of $10, and if the stock becomes $30, then the company sell the stock, yeah, its own stock, yeah, its own stock, yeah, to the market at 30. So making how much? $20 per share. I think that is the reason of this financial restructuring purpose. And of course, liquidation and bankruptcy. I don't have to explain why liquidation and bankruptcy. We are not interested in looking at that. Yeah, but of course, you should also understand what liquidation and bankruptcy is all about. I hope I've answered, sir. Okay, good. Now, let us, if there are no other questions, you have other questions? Okay, before then we will continue with the process. Okay, now this is basically the HP group for main financial restructuring. Yeah, split off into HPE. Yeah, that is Hewlett Packard Enterprise, and HPI. That is about 26.9 US dollar billion, yeah, of course. And the optoelectronic division spin-off, is about 2.1. Mergers with Compaq, about 25. Several acquisition, 23.5. So this is a summary of the history that we are going to learn in this financial restructuring, yeah? Okay, I want you to take a look at the details of the history itself in chapter 2. Yeah, in chapter 2. In chapter 2, you will see this. Okay? Everybody has turned into chapter 2? Okay. Now, this is the history of how I'm going to explain to you. Yeah? Remember, as I said just now, we are going to learn one case, which is what? Which is Hewlett Packard, which is interesting to learn from. Okay? Now, in 1999, a spin-off took place. Yeah, a spin-off took place. So the optoelectronic divisions from HP is being taken out, and it becomes what? It becomes what is called Agilent technology. Yeah, Agilent technology. We are going to learn about this, also as far as spin-off is concerned. Yeah, in 1999, 2.1 billion spin-off. And then, of course, you see here, in 2002, 3 years after that, HP is merging with Compaq Computer. Yeah, Compaq Computer. Yeah, so they merge with each other in the value of 25 billion in 2002. I think they are in the same industry, which is in PC. Yeah, it's in PC. So this is what happened. And then after that, in 2005, there are acquisition with Aruba, acquisition with the 3PAR and Com, acquisition with Autonomy Corporation, in 2011 and 2008 with the 3PAR, and then with Mercury Interact Software in 2011 in the amount of 4.5 billion. Yeah, and then in 2014, yeah, if you notice here, in 2014, HP was split up into two companies, the two companies that I mentioned just now. One is concentrating on PC, and the other one is continuing to concentrate in the optoelectronic, yeah, including advisory. Yeah, if you notice from my explanation in the chapter. By the way, before I forgot, I have shared with you, this is one of the chapter of my latest book, manuscript. It has not been published yet, but I think it is one of the chapter. Yeah, I'm sharing with you now. Yeah, this on restructuring. Yeah, hopefully I'm going to I'm changing my publisher. Yeah, from Rex Publishing to another publisher. It's a better publisher, C&E book. Yeah, so in the Philippines, by the way. Yeah, so I am taking this the one that I shared with you from, I think that is chapter 10, if I'm not mistaken. Yeah, chapter 10. Okay, good. So in the split process in 2014, yeah, HP was divided into two. And again, the reason, I have already given you just now. Yeah, why? It is well, of course, brand strategy is one. Okay, those are basically the history. Yeah, the history of how HP did experience this financial restructuring. Yeah, which it is very important for you to know. Yeah, as the accounting and finance scholars. Yeah, you should know. Okay. Okay. Good. Now, the first one, as I said, is the split up deal. Okay, you can read from that. And then you have the spin-off deal. Okay, I'm going to explain to you the figures, so at least you will understand of that. And these are basically the balance sheet of the Agilent technology. Yeah, you see here, this is just an idea. Yeah, this is just an idea. Before split, before spin-off, I mean. In 1999, I think it is like this: the total asset of 5.4 billion. But in 2017, just recently, I think it became 8.4. Of course, with an increased liability from 2.1 to 3.6. With the total equity increase from 3.3 to 4.8 in the period of about 18 years. Yeah, well, this is relative. So one can say, oh, why only growing that much? Why not more than that? You see, I think it is relative, right? Okay, so I think this is the example of how the Agilent technology works. Okay, now, here. By the way, is there any questions before we go to chapter 3? Any questions? You seem to be shy. Do not be shy with me, okay? Just, this is a learning process through this workshop. We are going to work more in detail with figures, yeah? Using Excel. Okay. Now, in the financial modeling methodology, I think we should understand this. You should first understand the financial and accounting concept, yeah? Well, and what is basically the problems, yeah? And what it is going to be accomplished for by using this financial restructuring techniques. Yeah, I think that first, yeah? If you understand the concept, then the next thing is you design, yeah? Design what you're going to, work on, like for instance, if it is an acquisition, you are pricing an acquisition, you try to put it into Excel, yeah? You try to put it into Excel, yeah? We are also going to work on the concept of capital budgeting, yeah, here. Okay, can I see those who are familiar with capital budgeting concept? Everybody understand, yeah? Yeah, everybody seems, because you are in the accounting and financial section. Yeah, we are going to, work on that. Okay? Of course, because of our timing, of course, I have my own strategy of how to conduct. It is supposed to be I've been discussing with Dr. Wayne in the email, in the communication through email. It is basically a 2 days workshop. Yeah, but let me try to make it 4 hours or a little bit less. Yeah, well, we do with the grace of the Lord. I hope we can accomplish this together. Okay, so you design that in what? In the Excel itself. So you have the input formats and you have the output formats. Yeah, that is always the case. So first you understand the concept, number one. You understand the concept and what you are going to accomplish. Yeah, for instance, you are going to see how to price the company. Yeah? If you're going to price the company, you are going to use a discounted cash flows technique. Yeah? Then you try to design it in your Excel. Yeah? Well, of course, some of you can make much better than what I have presented here. Yeah? And that is financial modeling on this, working on this financial restructuring itself. But I'm going to show to you how the inputs and the outputs should work together. Yeah? Including or putting the Excel formula is just a small thing of that. The most important thing is just what? understanding of the concept, what you're going to accomplish. Yeah, I think that is the most important thing. Yeah. Using the Excel formula is, nowadays, I think we have the luxury of what? I still remember, in way back in 83, 84. Yeah, I've been working with Hewlett-Packard calculator. That is a financial calculator. Yeah, with so many financial formulas there. Yeah, we can make decision right away. Yeah, but I still remember, in 1983, working with formulas. Working with formulas, all those formulas. We had a deal with the bank. My boss, the president director, assigned me together with my colleagues to work on a certain stock disposal. Yeah. And we are working with discounted cash flows. I think it was a long time ago. Yeah. And we use formulas. Yeah. But nowadays, no. Nowadays, those formula is just a prerequisite knowledge for you. Yeah. We have the luxury of using what? Excel. Praise the Lord. Yeah. Praise the Lord for HP, Microsoft, and so on. I think we have learned this technique well. Yeah. Okay. I think we have that luxury. I just want to let you know on that. Okay. Now and then build the output format. By identifying the main from that of the income statement components and the cash flows. Yeah. So we're going to work on this. Yeah. We're going to work on this anyway. Yeah. Okay, that is the methodology as far as what we are going to encounter this morning. Now, financial restructuring strategy. Yeah, that is the chapter 4. Yeah, in chapter 4. In chapter 4, we have this strategy that I would like you to take a look at. Okay? Okay, now, I want you now to change your file to the Excel file now. I want you to take a look at, so this is just a Word file, yeah? Let us take a look at the Excel file. The Excel file, the name of the file is this one here. APIU Excel Computation Ref. Can you open it? Can you open it so that at least I will show to you part of the methodology? Yeah. So now it is an Excel. Yeah, an Excel. Part. Okay. Everybody has this? Yeah. Okay. Good. Very good. Now here, this is what I mean. Yeah. These are basically the input format. Yeah? These are basically the input formats. As I mentioned to you, without realizing, you've been using this Excel, using Excel, financial modeling using Excel. Yeah? But of course, with different purposes, of course. Yeah? So this one is basically the input. Yeah? The input of... if you notice here, this is the input starting from sales growth until outstanding shares. There are inputs for the income statement projection. Yeah? These are the inputs for the income statement projection. Now, you see the projection here. The projection is reflected in this one here. Okay? Now, you see the projection. Yeah? is based on, this is the base, 1999, yeah? 1999, this is the figures that you can get from Agilent Technology, yeah? The figure that is there as you are growing, yeah, the income statement items there. You have, of course, the total revenues, yeah? You have the operating cost, yeah? Basically, operating cost is based on margin, but on the revenue, it is based on what? On growth rate, yeah? It is based on 14%, yeah, growth rate. And margin, of course, is based on what? 54.7% assumption. So that means 54.7 out of this, 54.7 out of this, out of this, out of this, and so on. You get all these, what little thing, yeah? Then they stem from the input forms, yeah? And the input forms is, you can see there, yeah? In the beginning of this file, yeah? And then, of course, you have what? You have the research and development expenses, yeah? Research and development expenses is also using margin. When you say margin, you are picking up what? You're picking up the percentage of the cost and research and development expenses out of the sales, yeah? Out of the sales. Also the same thing here. So you have here, we assume at 12%, then you have 12% out of this, 12% of this, 12% of this, and so on and so on, yeah? And of course, you know, you will have the gross profit. The gross profit is none other than what? Total revenue minus operating cost plus research and development expenses, or total operating costs. So basically, the total revenue minus the total operating costs here. Then you have the gross profit, okay? Then you still have the selling, general, and administrative expenses, the SGA expenses, which is also based on a growth, yeah? It is on a growth based on 7.6. 7.6 based on this, what do you call that, 1999 figures. So you grow. You grow. You can see the formula in the, what do you call that, in the Excel itself, yeah? You can see, and you can learn on how you work further on, what do you call that, projecting a financial statement, yeah? Projecting an income statement, I mean, yeah? Okay? Sure. And then, of course, you know, you have the EBIT. EBIT is basically, in finance, or even accounting, this is a term that we are using. Earning before interest and tax. Right, very good. Yeah? So EBIT. EBIT is basically an operating income. Yeah, it is an operating income or operating profit. So basically, it is the gross profit minus the selling, general, administrative. Then you have the EBIT here. Yeah? So you have the EBIT, and then you are going to minus it with the interest expense, other expense, or you're adding up with the other income here. And you have the profit before tax. Yeah? Profit before tax, and then you are taking, what do you call it, the income tax. The income tax is based on a 35% assumption. Yeah? This is what Agilent Technology is using, 35%. So we are just following what they're using, yeah? So 35% out of the profit before tax, yeah? So 35% out of this, 35% of this, and so on. Then you have the net profit, yeah? You have the net profit. Now, once you have the net profit, you know, you have the projected net profit over here, then now we are concerned with constructing the cash flows, yeah? We are constructing the cash flow. The cash flows, you know, are derived from adding the non-cash charges, which is depreciation and amortization. Yeah, you adding up. Remember, the depreciation and amortization, you know, is part of this operating cost here. You know, it has been deducted. Yeah, it has been deducted from you know, the sale, you know, in the items that is called operating cost. Yeah, and now we are adding up again in order for us to come up with the cash flows. Yeah, in order for us to come up with the cash flows. So we are adding up here the cash flows. Then we have the basic income cash flows. yeah, which is here. Okay, you see that? And then we still have the terminal value. Yeah, terminal value is the value at the end of the. We are using 5 years here. Then of course terminal value will take place in the 5th year. Yeah, in the 5th year. So now we are going to learn how we compute terminal value and so on. Yeah, okay. Now we have the basic income over here. Yeah. Now, what we are going to look for here first is in the spin-off process. There are 2 things that we are going to learn on the spin-off process here, okay? Using these figures. The first one is, remember when a subsidiary or a division is being separated from the group itself, there are certain expenses that, the company is going to what? It's going to spend. And this expense is basically the additional investment. Because, you cannot do, while the spin-off, of course, like for instance what? The legal cost, yeah? Additional infrastructure, for the building itself, yeah? And so on. So there is certain component of capital budgeting that we are looking at here. So the first one in the spin-off that we would like to see is the decision-making process. Yeah, decision-making. And decision-making here is basically on using a capital budgeting technique. And the capital budgeting technique that we are using here is basically using what? Anybody here can tell me? You are from the accounting, and what are the 3 basic capital budgeting techniques? The indicators. I'm asking you the indicator. I give you one. Internal rate of return. Does it sound familiar to you? Yeah, internal rate of return. So that is the first one. Internal rate of return, or IRR. What is the second one? Yes, very good. Net present value. Yeah, NPV, net present value. What is this third one? It is all there, It's all there, if you notice. It is all there. Yeah, here. Yeah, it is all here. Yeah. What else? Look at the other side there. What are they there? Huh? Yes, of course. Well, the professor is helping me. Yeah, it's the payback period. Yeah, it's the payback period. So basically, we have 3. Yeah, what is this? IRR, NPV, and the payback period. So in the spin-off, the first one is the decision. Why? Because of additional investment. Additional investment. Yeah? Like the infrastructure of the spin-off company, yeah? The legal expenses, the surveying, and so on. There are, yeah? And that is basically, in our example here, I think the additional, expenses for that is 1,200 million. That is more or less 1.2 billion. Yeah? So 1,200, that is the amount that Agilent is thinking. By the way, it is not exactly like what Agilent says. There are some assumption here. Yeah? Even in my books also, I mentioned that I am assuming, so that the reader will understand that this is not all actual figures from the spin-off, yeah, because I'm using a certain degree of assumption for learning process of the readers of my future book, yeah, on this latest book, yeah. Okay, so we are here assuming 1,200 with this cash flows, yeah. Okay, now. The second one is, after decision, using this capital budgeting, we are using pricing. In the exercise, I think we are going to work more on this. Pricing Agilent. Yeah? Remember how much the price? This is actual. This is actual pricing. Yeah? This is actual pricing. The pricing is, I'm sorry, I think it's still peso. It's supposed to be US dollar. Yeah? Just, what do you call that? Can you just assume that this is US dollar? This is not peso. It's supposed to be US dollar. Yeah? Okay? I think it is the price of 30. Now we are going to learn how we come up with that 30. So that is the second, what do you call that? Second process that we are going to look at this workshop. Yeah? Okay? Yeah. And of course, we are using what is called as discounted cash flow. Discounted cash flows. Or normally it is DCF. DCF techniques, yeah. Anybody here, well, of course, the professors are familiar with that. Let me ask you, are you familiar with DCF? Have you heard about that? DCF, yeah? There's several good books about discounted cash flows, yeah? You can look at Amazon or Pearson or whatever, yeah? And get some references for that, yeah? So these are basically pricing a company. Yeah? Pricing a company. We are not talking about pricing a stock. No. Different. This is pricing a company. Pricing a stock has different, what do you call that, technique. Yeah? You can use the dividend discount model. You can use the PE or price earning ratios and so on. But this one is especially a DCF thing, yeah, in using the pricing. Okay? And then the third one that we're going to learn this morning, which is still part of the coverage of the video here, is leverage buyout, or LBO. Yeah? LBO. What are we talking about here? Basically, it is also a capital budgeting technique that you're using. But in this case, in the LBO, yeah, the employees are taking over from the existing shareholders. Using what? Using financial leverage. I give you a certain, what do you call that, so at least it is still covered here before we work on the exercise. It is like this. Agilent has been formed as a separate company, as a separate spin-off company from Hewlett-Packard, HP. Now, the employees of Agilent are thinking of owning the company itself. You understand what I'm saying? Yeah? Owning the company itself. By what? They are getting a loan from outside to pay the existing equity of the shareholders. And they are going to pay the loan automatically within a certain period of time, 3 years, 5 years, 8 years, or 10 years, whatever. Yeah? In this case, we are learning about 5 years. Yeah? And then after that, it is owned by the employees. This is how leverage buyout. We're going to learn, yeah, using the figures here. Okay? Yeah? So this is the agenda of how we are going to. By the way, what time is it now? So that we can take a break for a while before we start. Oh, at 10. Oh, we are not yet 10. Yeah. How much? What time is it now? 9:25. Okay, then we can still, maybe after the break, we don't have to cover because we're going to work with, what do you call that, with the Excel. Yeah? Okay, now let me, what do you call that, make it more solid so that you have a solid understanding about the three things that we are going to first. Number one, this is what we're going to first study now. in the workshop, in the exercise. Number 2 is the pricing, yeah, using the DCF. And then the third one is the LBO, yeah, leverage buyout, yeah. So I hope that everybody understands this on the process. So the Agilent technology, yeah, the separate spin-off company, yeah, the employees. Now we are talking about employees. Hey, you know, the shareholders are really, enjoying this spin-off, a very good price and so on, at a price of how much? It is $30. This is actual price. This is the actual price in 1999, yeah? $30, per share, yeah? Why don't we own it? You see, yeah? The employees are saying, why don't we own this company? Yeah? And they come together and said, okay, fine. We are going to what? We are going to repay the equity of the firm, yeah? I think the equity of the firm is by the way, this is in sheet number 1, yeah? In the first sheet. The equity of the firm, I think it is in sheet 2. I think that is 338. I think this is the one. This, by the way, this is in sheet 2, yeah? In the same file, but sheet 2, yeah, not sheet 1. The first one is sheet 1, yeah? Okay, so this is in sheet 2. This is what the employees is going to pay, yeah? The employee is going to get as a loan, yeah? 3.3, oh, very big, yeah? 3,382 million, that means billion, yeah? 3.3 billion. Yeah, they said, no, we can do it, yeah. We are going to get a loan and repay this existing shareholders, yeah, who are owning 3.3 billion, you see? And that's why they're getting a loan. Getting a loan, and then they pay the old shareholder, okay? And that loan is basically a loan that is reflected in the balance sheet of Agilent, yeah? And then bit by bit, it is going to be. So we're going to learn more on this, yeah? On the LBO itself. But basically, this is the amount that we are going to, that the employees are going to pay, yeah? Okay. Let's go back to sheet 1 again. Yeah? Okay, now, let me explain to you the inputs and the output process in more details, yeah? So that at least you will understand, yeah? Okay, I think I've started first with the input just now, yeah? Now, let me continue the explanation which was interrupted just now. The first one, we have the inputs, yeah? For the cash flow projection. You have the sales growth percentage. You have the operating cost margin, the R&D expense. By the way, R&D is research and development, yeah? Of course, everybody understand the word itself. R&D and the SGA expenses, existing, interest expense, other income, the depreciation, the income tax rate, and the outstanding shares. Yeah, these are basically inputs, assumptions for the projected cash flows. Yeah, for the projected cash flow. And then we are going to skip this. We are going to look at this in the third, LBO. Yeah, and then we have the input, data that we are going to translate them into the output. Yeah, the projected cash flows. Yeah, the first one is this 1,200. Remember, what is this 1,200? This is the amount expense for setting up this new company, yeah? The spin-off company, yeah? Remember? Yeah? HP take it from the Opto Electronic, yeah? And it is new. It is a new company now, yeah? Of course, there are some expenses involved, right? In any spin-off project, it is very or highly impossible for the spin-off company not to expend some amount, yeah, to spend a certain amount of investment, yeah, as a startup process itself. Yeah, in this case, by the way, this is not an actual figure. This is an assumption. Yeah, but so at least we understand the process. Yeah, 1,200. We put 1,200, and then this is one important thing that I would like you to understand. Let me ask you first, just to test your understanding as far as this. Now, when HP is setting up this Agilent technology, this spin-off company, yeah, where does the money come from? And I'm talking about this one here. Just open discussion. Where does the 1,200 come from? Yeah, okay. Borrowing from own company or whatever. But what are the possible sources? Can you think about that? What are the possible sources of that 1,200? I forget your name again. Phasing. Yeah, I'm sorry, I had a problem in sometimes memorizing phasing. Yeah, can you comment on that? Phasing. Where does this 1,200 come from? Let's say, for instance, if I'm buying let's say, setting up a company, okay, or I'm buying a certain company, I'm acquisition. Yeah, this is an acquisition company. We'll just get it from our equity. Yeah. Or I said, well, we can just borrow. Yeah, borrow. So from these funds, then I can buy that company, right? Now, on this Agilent, yeah, this 1,200, what can you comment the money could have come from? Issue of stock. Yes, it's right. It's right. You can issue stocks, and you have the money, yeah? And then put the money in this. Well, of course, you need maybe to build. Agilent needs to build new buildings, maybe. Yeah. Agilent needs to pay the lawyers, maybe for setting up this spin-off company and so on. Yeah. And also, other expenses. Yeah. Okay. Yeah. So stock. What else? What about loan? Is it possible for HP to get a loan to? Yes, possible. Yeah, possible. Yeah, to get a loan. Yeah, or from its own equity. Yeah, not through the IPO, not issuing a stock, for instance, or IPO is just the first time, and then after that, you use right issues. Yeah, right issues itself. No, now, so what happened here is that this 1,200 comes from the main company, which is what? What is the main company? Yes. HP. So Agilent is basically its subsidiary, right? So the cost of capital is not coming from Agilent, no. I want you to understand, this is basic and fundamental. Yeah? The cost of capital for that 1,200 comes from the parent company, which is HP. So we have to get the cost of capital from the parent company, which is HP. So in this case, the capitalization of HP, yeah? So this is HP capitalization. The first one is debt, yeah, or long-term debt. Long-term debt. How much? It is 1764, yeah, million. And then equity, of course. You see the equity, the stockholders' equity. So equity itself has 18 to 95 million. With a total capitalization of 9,510 902. Yeah. Okay? Now, each components are here. In cost of capital, you are familiar in financial management, that is called weighted average cost of capital. Yeah, we are going to also compute that. Yeah, the weighted average cost of capital is that for long-term debt, what is the cost? 11.5. Yeah? So in this case, this is the amount. This is the cost. Yeah? The cost for long-term debt is 11.5%. And the cost for equity, you need to compute. Yeah? You need to compute. We are going to, what do you call that? I'm going to show to you in the, we go back to the Words file. Yeah? In this case, we have basically, I think in the output format, the cost of equity would be 19 point, this one, KE, yeah? KO is basically, well, KO is not knocked down, but this is cost of capital, yeah? KO, normally that is the acronym for that, KO, yeah? KO. But KE is basically cost of equity, yeah? This one is KD, cost of debt, yeah? This one we have computed as 19.9, yeah? 19.9. So 19.9%. And this is basically the KE, yeah? Basically the KE. Now, let me lead you now to how we compute that, yeah? We go back to the file. We go back to the file, okay? We go back to the file, the Word file, yeah? This one here, okay? This one. In chapter, I think the last chapter, if I'm not mistaken. Then we take a look from here. Anybody can identify in your file? Yeah, in the Word. This is the Word. So we go back to the Word file, yeah? We go back to the Word. Okay? This is how we compute. Yeah? Okay? So long-term debt, long-term loan of 1764. And the equity of how much? 18,295. Yeah? Okay? Now, remember that 1,200, what we've seen just now? Yeah? 1,200, that is the additional investment for the spin-off project, yeah, this for Agilent, yeah, is being financed through what? Through long-term loan and stockholders' equity. Yeah. Now, how do we compute that? Yeah. Okay. Here, for the cost of equity. Oh, by the way, the 11.5 is being given. Yeah. It is given anyway, so there's no problem. You don't have to compute. Okay? What you need to compute now is the KE, or the stockholders' equity cost, which is 19.9. How do you compute? I think this is how you see in the file, right? Yeah. First is the payout times EPS. Yeah. The payout is basically the payout of the dividend. Yeah. Payout, dividend payout. Okay. How much is dividend payout according to the assumption? 18.5, yeah? 18.5. Let me, 18.5. Here, I put the assumption there in the input, yeah? 18.5 here, right? So this is an Excel file, yeah? I'll go back to the file. So 18.5. I put there in the input, okay? And then let's say, let us go back to the file again, yeah? And then it says what? 18.5 times 3.5. 3.5 is the EPS, right? The earning per share, yeah? We have also that assumption. Yeah, so what is the assumption there? 3.5, right? So 3.5. See? You put there. So you build up the input process in such a way. Well, as I said, some of you can design a much better, financial modeling format. Yeah? Yeah, but at least you understand. Okay, now 3.5, okay? Now, and then let us continue. What does it say here? So the payout times the EPS, 18.5 times 3.5, divided by the price per share. This 14.7 is also there in the Excel formula. You see that, right? In the input, section. Okay, and then plus 19%. 19% is the ROE. Yeah, the ROE is also given. Yeah, the ROE is given a return on equity. Yeah, it's given there. How much is that? It's assumed at 19%. Yeah, this is just the price, 14.7. It's also part of that. Yeah, and then what else? And then we see again how plus 19% times 1 minus the payout, the 18.5%. Yeah? Then you get 19.9%. Yeah? So 19.9% is the cost of capital for that 1,200 investment of the spin-off. Remember, we're still in number 1 here, yeah? We're going to see whether that 1,200 is worth considering or not. Yeah, we are not yet in the pricing. Yeah, it is still in the Okay, now you get the cost of equity total. Then this. Remember, I think that's part of the exercise as well when we do the exercise. Here, I put here the percentage. Remember, you have to come up with the percentage, the weight of the capitalization. The capitalization comes from long-term loan and stockholders' equity, right? So 1,764 divided by this, then you get 8.8. 18 point divided by this, you get 90.1. These are the weights. Okay. Now the weights are going to be multiplied with the cost. 11.5 for loan is given. Yeah. 19.9% for equity was computed. Yeah, we have computed just now, right? So you now multiply them. This times this, then you get this. This is the weighted average cost of capital. So you get this times this, you get this, and you add them up. And you have this 19.2%, which is reflected in the output format. Yeah? It is in the output format. How do you see that? Of course, I think it is in here. You see? Yeah? Here. How much? 19 point? Oh, sorry. Output. I'm talking about output here. So the output here. Yeah. How much is the cost of capital, the KO? 19.2, which is this. Yeah, 19.2. Yeah? So the exercise I want you to do on the first one here, is to tell whether the 1,200 is worth considering or not. Yeah? And then we start with another one, which is the pricing. Yeah. Okay, now, until now, here, is there any question on the first one? On the decision? Any questions? Anyway, question will come in the exercise. It's fine. Okay? Now we talk about the second one, which is what? The second one would be the pricing of Agilent. Yeah, the pricing, which is this, here. How do we derive at $30 per share? Yeah? Remember, this is not the pricing of a stock. No. A pricing of a company. And that company is the Agilent, the spin-off company. Yeah? So we are now looking at this $30. I'm very sorry, again, this is supposed to be dollar, it's not supposed to be peso. Maybe the computer is automatically picking up peso. Yeah, okay. So we are now working on this 30, yeah? The first, what do you call that, process that we need to do is getting this net discounted cash flows, 15.644. Yeah, 16.44. Okay, 16.44. In the exercise, I'm going to repeat this again, and then we do exercise. Yeah? Okay? So at least you are familiar with the thing. Okay, good. So I think you understand on the second one, which is pricing Agilent by using discounted cash flows. Yeah? In the what do you call that example of pricing, DCF. DCF is being computed by the cash flows, the accumulation of cash flow, 1 plus the KO, yeah, power n, yeah? In this case, I think it is 5. N is 5, yeah? Now, plus the terminal value, yeah? But remember, you should understand this as a what? Remember, now we have the luxury of using Excel. Now, we don't need those formula anymore, yeah? So this is basically how we compute the DCF, yeah? And DCF, which is this one here. This is the result, 15,644, okay? How do we compute? We are going to do the exercise, yeah, in the exercise portion, okay? And the last one is, let me finish with, is it, Mamlin, is it 10 o'clock now? Almost, okay, good. I hope I can find, because after this, then the coverage, the video coverage will end, yeah? And then after we come back, after the break, then we'll start working on the exercise. Yeah, okay, until 12 o'clock? 12 o'clock, okay, sure, good. Okay, good. Okay, so the leverage buyout. Now, remember, Agilent technology is there. As what I mentioned just now, I'll repeat again. So, my strategy is always reinforcement. What I said now, I said again. And then I said again. I said again. So that will be implanted in the minds of my students. Normally, that is how I work, yeah? I will say that again. Okay, now, in the leverage buyout that works out, the Agilent technology is still owned by the shareholders, right? It is owned by the shareholders. Now the employees said, hey, that 3.3 billion, 3.3 billion, sometimes, I'm so enthusiastic that, yeah, 3.3 billion, yeah? Why don't we own this 3.3 billion? Why don't we own this? Yeah, this is what they're saying. Welcome, sir. Have a seat. Yeah. So then I said, okay, how? How? Shall we get a loan? I think I know from Prudential Bank, they give a loan. Oh, no, don't. For Prudential Bank is expensive. Why don't we get from the microfinance if they have the funds? No, they do not have that much money. Where should we? Shall we just go to the pension fund? A pension fund will charge a small amount of interest cost. Then they go to the pension fund, and they get this 3.3 billion equity of the existing shareholders. Once they get this money, 3.3 billion, hey, Mr. Shareholders there, we pay your equity. And that is the debt that they get, right? Now that will be, this debt, 3.3 billion, will be what? Will be repaid in a period of 5 years. We're going to look at that. Yeah, we're going to look at that. Okay. Now, why don't you take a look now? This is sheet 1, yeah, by the way. Shall we go to sheet 2? Yeah, shall we go to sheet 2? Now, you go to sheet 2. Now we look at this here. So what do we have in input form? The same input form, right? Even though the assumption might differ. Yeah, the assumption might differ. The assumptions will be made by the employees on how the companies will perform in the future. Yeah? So these might differ. Yeah? It depends on the visions of the employees. Because remember, they're paying the shareholders, right? And now it will belong to them, to these employees, in a period of 5 years, provided the loans are all paid off. Yeah? When you say the loan, of course, the amortization consists of the principal of the loan plus the interest cost. Yeah, we're going to take a look at that. Yeah? Okay. Now, you see here, inputs for loan amortization. How much? How much are the employee paying? Yeah, 3,382 million. Yeah? So that is the amount that the employee gets. They have agreed upon. Prudential Bank costs a lot. Microfinance said they don't have the money. Why don't we just go to the pension funds of the United States? Then they go to that, what do you call that? Yeah, and they get the loan at a lower cost. Yeah? Let's assume that even though this is not lower cost, yeah, but just for, what do you call that, example purposes. Yeah? So this 3.3 is going to be paid in 5 years, 0 in 5 years, at an interest cost of 10% per annum. Yeah? Per annum. It is always per annum. Yeah? Okay, good. Now, let us see what we have here. Let's see now the output format. The output format. Here. You see, the projected cash flows might differ. Yeah? This assumptions of the projected cash flow comes from the employees. Yeah? Now, this is the amortization schedule. Amortization schedule. Here. This is the amortization schedule. Yeah? Remember that the amortization, here, the amortization is the same. It is based on declining interest payment. Yeah? So what happened here, amortization is the same, 892, but the interest expense, 892 in the first year consists of 338 interest expense plus the principal reduction. Yeah? Interest expense is basically 10% out of this. You see that? Yeah? 10% out of this. Okay? Now, the second year, 892 minus 338 is the 554, which is the principal reduction. So this principal 554 is being deducted from 3382. So the outstanding now is how much? 2828. The second year, the same 892, the interest is going to be 10% of the, you see this? Yeah, the outstanding loan. Yeah, so 283. So automatically the amount of principal that is going to be deducted is bigger. Yeah, 892 minus 283 is 609. And this 609 is going to be deducted from this one. 2828, then it becomes 2219. So in the third year, the same amortization, 892, interest is 10% of the outstanding, the previous outstanding, which is 224, and so on and so on. And it should, the outstanding loan should become 0. If it is not 0, you might have inputted wrong formula there, a wrong Excel formula. Yeah? Now, basically, this, what do you call that, amortization is following So amortization is computed by the principal divided by one minus 1 over 1 plus the interest cost, which is KD, yeah, divided by KD. So this is the, what do you call that, manual formula, which we are not using anymore. We can just use what, because we do have the luxury of the Excel formula with just input. Yeah, just put the, we're going to look at the exercise of what to input. Yeah, what to input in the Excel formula. Yeah, to work that. And then now we see here that this interest expense is part of this projection. Here, interest expense. 554, so this is part of this. 338 is part of 554. Remember, it has the existing expense before. So plus this. So it is going to be this one. Yeah? Also like this. 283 is part of this. 222 is part of this. 155 is part of this. And so on and so on. Yeah? And then, of course, the company, as usual, have this, what do you call that, basic income. And the basic income itself will be computed exactly like this, using a capital budgeting technique. Capital budgeting technique. In order to say, what? Oh, okay. Now, you see here. Yeah? Okay, I think we need to see the output. Yeah, sorry. Here. Here. The projected cash flow that is designed by the employees, yeah, which is this one. Here. Which is this one, yeah? And where? Here. It has generated 121%. 121%. Yeah? And now, how much is the interest cost? The interest cost of the employees? 10%, right? So what does it mean? It means that the project is good. Yeah? The project is good. Yeah? As far as the first one is concerned, if the project is good or not, I think this is the formula. The IRR should be bigger than the cost of capital. Yeah? So, NPV should be positive. Yeah? I think this is, then we say, okay, the project is good. Then that is how the LBO works.